In this video, I'm going to be discussing the difference between tax preparation and tax planning. Also, how it's tax planning, not preparation, that actually saves my clients thousands of dollars in taxes. And also my thoughts on what your approach should be to tax planning. And so if you're a real estate professional or small business owner, you're going to want to listen up, because this is probably one of the most important videos you'll watch in regards to how to save money in taxes. Quick introduction. For those of you who don't know who I am, my name is Navi Miraj. I'm a CPA that specializes in helping real estate professionals. So that's your real estate agent, realtor, or broker save thousands of dollars in taxes. And I help clients throughout the country. But if you're a regular, more traditional small business owner, these same strategies are going to apply to you. And we're going to get into some of the stuff that I have on this board here. But before I jump right into this, which is more of the tax planning side of things, I want to define what tax prep is. And so, it's unfortunate, but I would say 80% or more of, even CPAs or accountants or tax professionals or whatever you want to call them, they really just do tax preparation, which means, unfortunately, the relationship is very transactional in nature. So you're dropping off maybe your revenue and expense detail. They're plugging it into their software, or maybe one of their staff is plugging it into their software. They give it a quick review, you pay their invoice, you pay your extra large tax bill, and you move on like that from year to year to year. But what you don't realize is happening behind the scenes there is, the majority of those folks aren't actually trying to help you reduce your tax bill. They just don't have time to do it. They're charging you, one small fee, here's your taxes, move on with life. They got to get to the next client in order for them to make any money in that business model, right? It just makes sense. They can't spend a lot of time reducing your tax bill. So I think a lot of clients or prospects that come to me think that their current tax advisor is actually saving them money in taxes by when they prepare their taxes, but it doesn't actually work that way in real life. What tax planning looks like is, at least for my clients, is I have about an hour-long conversation with them to find out about their business. Which of these strategies are they not using and can be using, and how much is that going to save them money in taxes? And at the end of that call, or when we're having that conversation, we may uncover anywhere from as little as $5,000 or as much as $15,000, $20,000 in potential tax savings. And this is not for clients that are not working with CPAs currently. This is these numbers that I'm kind of throwing out there are for even with clients that have had a tenured relationship with the CPA. So tax planning saves thousands of dollars in taxes because it's proactive in nature, not reactive as in the tax preparation. And you enact these strategies throughout the year, not during the time when someone is preparing your taxes, because we really, we're preparing your return in the year after in which the events took place. So for example, preparing your 2020 tax return in the first quarter of 2021, and we can't go back in time and implement some of these strategies. So thanks for being patient with me. I needed to have a definition of tax planning versus tax prep before we jump into the content here. So let's talk about tax planning at a high level. So here are what I refer to as sort of the steps to tax planning, right? So it might sound like super obvious, but step one is to earn revenue. You've got to be, if you're a real estate professional, closing deals, making commissions, or if you're a more traditional business owner, selling product or your services and earning revenue in order for us to implement any of these things, right? I can't really save you money on taxes if you're not making money to begin with to be taxed on that income, right? Sounds super obvious, but the reason why I want to highlight that as step one is a lot of people jump to these different, forming a legal entity and all these different things before they're even made their first dollar. And I really think you should, probably have a business plan and some other things should take place prior to worrying about some of the tax structure and the legal entity structure. But that being said, after you're making money and you're earning some revenue, the next step is maximizing deductions. And so what I mean by that is, let's take a look, and I've just put a few of them for example, there's more than this, but let's look at home office deduction. And let's talk about that for a quick second. So a lot of people are like, oh, there's a red flag, so for an audit, so I don't want to use the home office deduction. Others of you are working with tax professionals who they just want to use the simplified method, which is basically saying, hey, $5 a square foot of business space in your home is what the calculation will be. But I'm telling you, there's other strategies around home office to where you could be deducting a percentage of your mortgage interest, your real estate property taxes, your utilities, the cleaning service for your home. There's other things that go into that calculation to make the home office strategy like 3 times as more powerful than just using that simplified method. Same sort of thing applies for auto. A lot of my clients are real estate professionals, so they do rack up a lot of miles on their car, and the sort of mileage method is the best for them, but that's not always the case. There could be depreciation and bonus depreciation that will save you more money in taxes than doing the standard method, if you will. Travel, I'm not talking about just business travel here, but how can you have business travel, maybe bookend your business travel with personal travel as well on the weekends? And how could you make that 100% tax deductible as opposed to just 30% of the trip is tax deductible, for example? Hiring children is a huge one. Stop earning money, paying taxes, and then paying for your kids' expenses like video games or whatever, or a new computer, laptop, cell phone, car insurance, all that stuff. Get them involved in the business at a young age, from the age of 7 to 17 years old, and get a business deduction for paying them, and then have them buy their own stuff. I'm not telling you to go, just get a deduction and you're going to lose out. I'm saying you get a deduction and they get tax-free income. It's another strategy. But anyway, the point of the matter is, after you're earning revenue, I want you to maximize your deductions by using strategies like the ones I've highlighted below. And by the way, if you haven't subscribed to my channel yet, now's probably a good time to do so, because in future videos, I'm actually gonna go through all of this stuff in detail and teach you, or at least give you enough information so that you can either ask your tax professional or you can run it by me on how you should be approaching this strategy. So after we've maximized deductions, depending on how much profit is left over, then we're going to start to visit, okay, well, were you, or are you, or should you be rather, in a specific legal or tax structure? So, I've got LLC versus PLLC, so that's like professional limited liability versus your plain vanilla limited liability company. Should you be a professional association or a professional corporation? If you're not sure what these terms are, this is mainly for people who have a license in their state to practice their business, such as like a CPA, some real estate agents, and what have you. When should you become an S corporation? A lot of people jump straight into this S corporation tax classification, and they're not ready yet, because once they maximize their deductions, they don't have enough net income for the S corporation to even make sense just yet. So I'm just saying, don't jump the gun. Don't form these entities until you kind of map it out and speak to a professional who can tell you when it might be wise to do so. The S Corp strategy, just so I can hit on it, I've got other videos that touch on it and explain it to you in more detail, but this typically makes sense when you have about $40,000 or so in net profit, meaning after you earn your revenue and after you maximize your deductions. If you still got 40 grand or more in net profit, we should probably then talk about this tax structure. Retirement. I'm not going to talk about this at length, but the point I want to make here is, don't think that when you're a business owner, you need to limit yourself to the IRA, which you can put $6,000 or $7,000 into per year. There's other strategies. You might be the SEP IRA might make sense for you, depending on how much money you want to put aside. There's solo 401k plans. So what I'm getting at here is, depending on how much you want to put into retirement, changes which plan is right for you. It could be 6,000 or 7,000, maybe 7,000 to 15,000, or 15,000 or more. Changes what plan is right for you, and also the deduction that you could be getting for it. Step 5, legal loopholes and niche strategies. Don't let this scare you. When I say legal loopholes, I mean these are 100% legitimate, bona fide tax strategies. Okay, I'm just saying, using the tax law to your advantage. The rules are there for everyone to use. Why not leverage it? So this might be things such as like the Augusta rule, which high level allows you to rent your home out to your corporation for maybe board meeting minutes with other advisors, or if you have clients or prospects at your residence, it's like a networking opportunity for you. Real estate passive activity losses. A lot of my clients are real estate professionals, and so their tax preparer needs to know, should they be a real estate professional? And so any losses that get produced from rental real estate property that they own can be used to offset maybe not only their income, but their spouse's W-2 income. So if you're not talking about that and you're not aware of these strategies, this is a strategy that I don't even get as a CPA. It's only available to real estate professionals. 1031 exchanges, that's basically saying that, hey, I invest in real estate property, I want to now sell that home and I don't want to pay taxes on the gain. I want to roll those profits into my next, venture related to real estate. And so you don't have to pay tax on that money when you sell. You just keep kind of rolling that forward and building your portfolio of real estate investments. So look, this was just a high level overview of tax planning. As I said, if you want to learn more, subscribe to my YouTube channel, or you can visit my website at navimirajcpa.com. I'll put the link in the description and everything below. And like I said, make sure you subscribe, because what I plan to do to help you all out, because I've been getting a lot of feedback on this, a lot of comments, is to actually hit on these strategies one by one, sort of teach you about them so that you can ask your tax professional, or when we chat, we can have an educated conversation about it to see how powerful these strategies could be for you and how much money you could save in taxes. So with that said, I will see you in the next video.